By the time most of the Western world rolled over and hit the snooze button, something irreversible had already happened. Not with a bang or a press conference, but quietly, the way real paradigm shifts usually occur. While Wall Street's algorithms were still arguing with themselves about inflation expectations, and while the doors of the US Mint stayed politely closed to the public, a line was crossed in the global financial system that does not come with a rewind button. The closing data out of the Shanghai Gold Exchange for Wednesday, January 14th, 2026, delivered a number that was more than a price. It was a statement. The Shanghai silver benchmark finished its afternoon session at 101 at around 71 per ounce. That single extra digit matters more than most people realize. For half a century, silver has lived inside a psychological cage. It bounced from $10 to $20, flirted with $50, and every time it tried to escape, it was shoved back down like a bad idea at a risk committee meeting. Triple-digit silver, $100 an ounce tours, was treated as fantasy. Something reserved for internet forums, diehard stackers, and people who own more safes than furniture. And yet, here we are. That fantasy just became the cash price in the world's largest manufacturing economy. Let's be clear about what this number represents, because context matters. This is not a leveraged futures contract being traded by speculators who may or may not still exist next quarter. This is not a theoretical price about what silver might be worth someday. This is the real, physical cash price paid by industrial buyers in Shanghai and Shenzhen for metal they need right now for immediate delivery. They didn't blink, they paid over $100 an ounce and moved on with their day because they had to. And this is where human psychology quietly steps onto the stage. Behavioral economics has a concept known as unit bias. As long as something is priced in double digits, our brains tend to categorize it as common, accessible, maybe even cheap. The moment it crosses into triple digits, the mental filing cabinet changes. Suddenly, it's scarce, precious, something to think twice about. China has accepted this new story. Silver in their market is now a triple-digit asset. The problem is that the United States hasn't caught up yet. If you look at the New York market, silver printed an all-time high this morning at $92.23 and is currently trading around $91.63. That's a historic number by any conventional standard. It's a record. But in the current context, it's also a discount, and a very large one. There is roughly a 10 gap between the silver price in New York and the price in Shanghai, $10. In commodity markets, that's not a rounding error, that's an invitation. If you can buy silver in New York for $91 and sell it in Shanghai for $101, you're looking at a near instant 10% return. That's not clever trading, that's gravity doing its job. This spread all but guarantees one outcome. Metal will flow from west to east until there is nothing left to flow. Vaults in London and New York don't get to argue with arbitrage. They obey it. The price in the West will rise to meet the price in the East, or the West will simply run out of silver. Those are the only two options on the menu. We're already watching the catch-up attempt in real time. The US market was up roughly 6% today, which is a massive move by any historical standard. And yet, it's still chasing the Chinese market's taillights. The push to a new all-time high matters because once an asset clears that level, the technical landscape changes completely. In technical analysis, breaking an all-time high puts you into what traders call blue sky territory. There's no overhead resistance, no crowd of investors from 10 years ago waiting to sell just to get their money back. Everyone who owns the asset is in profit. Above you, there's no ceiling, just air. The move from $92 to $100, technically speaking, faces very little resistance. What it does face is psychological resistance, and that's where the banks come in. Make no mistake, the $100 level will be defended. Not because it's magical, but because everyone understands what happens once it breaks. Media coverage goes from niche to unavoidable. Headlines change. Retail investors who never cared suddenly care. The conversation moves from interesting to urgent. Banks know this. The question is whether they can actually hold the line. Look at today's volume. Look at the way every dip is being bought almost instantly. Smash attempts don't last hours anymore. They barely last minutes. The usual playbook isn't working. The banks are effectively fighting a two-front war. On one side, they're trying to manage the chart in New York. On the other, they're staring at the reality on the ground in Shanghai. And by any honest assessment, they're losing on both fronts. The Shanghai close above $100 is a signal flare. It tells us something critical. Industrial consumers in Asia have capitulated. These are not speculators. These are companies that actually use silver, battery manufacturers, solar producers, electronics giants. They've stopped waiting for pullbacks that may never come. They're buying at whatever price is necessary to keep their factories running. This is the inelastic demand problem that's been discussed for years, finally made visible. Samsung cannot pause battery production because silver got expensive. BYD can't stop making electric vehicles and wait for a better entry point. Solar manufacturers don't get to take a timeout. They buy, or the lights go out. When necessity meets scarcity, price becomes secondary. So what does this mean for an investor sitting in the US or Europe right now? It means you were staring at a very narrow window, maybe 24 to 48 hours, where silver is still priced in double digits in your market. You're being offered an asset at $91 that the rest of the world has already repriced at $101. That is not speculation. That's temporal arbitrage. You're buying yesterday's price in today's market, but that window doesn't stay open long. As the news of the Shanghai close spreads, arbitrage bots will wake up, high-frequency traders will front-run the US Open, and the gap will close, likely violently. The markets hate inefficiencies, and they correct them with enthusiasm. The century mark isn't just a number, it's a barrier to entry. Once silver settles above $100, accumulating large quantities becomes psychologically and financially harder for casual buyers. The poor man's gold starts shedding that nickname. It doesn't become unaffordable. It becomes respected, and silver isn't moving in isolation. This looks like the early stage of a broader repricing across the commodities complex, led by what may have been the most undervalued asset in the room. Now, here's where the story takes a turn that many in the precious metals community have waited decades to see: bank capitulation. For years, the narrative was simple. Bullion banks were the villains. They were the shorts, the paper sellers, the ones leaning on the market every morning. Retail investors feared all-time highs. Hedge funds hesitated without a clean catalyst. So who, exactly, is buying enough silver to push it up $5 in a single session, straight into historic resistance? The evidence increasingly points to the commercial banks themselves. This isn't ideology. Banks don't hate silver, and they don't love fiat currency. They love solvency. For years, being short silver was profitable. Sell paper, collect premiums, wait for decay. It worked until it didn't. When silver crossed roughly $85, the insolvency line many analysts warned about, the math stopped working. Physical metal wasn't there. Shanghai was bidding triple digits. Risk managers noticed. So the banks did what mercenaries always do. They switched sides. First, they covered. Then, quietly, they went net long. We're now seeing signs that the largest bullion banks are positioning themselves to profit from higher silver prices, not suppress them. Infinite liquidity is a powerful thing. Used against a market, it's a headwind. Used with it, it's a tailwind. And that changes everything. When banks were short, every rally had a ceiling. Now, the former suppressors may be the accelerators. If that's the case, silver doesn't just grind higher, it reprices. The century mark isn't the end of this story, it's the beginning of a very different one. The only real question left isn't whether $100 holds. It is how far the market has to go before it finds equilibrium in a world that suddenly realizes silver isn't much common at all. You don't need a crystal ball to understand what's happening here. You just need to follow the data trail, and nobody follows it more closely than the banks. They don't rely on headlines or Twitter sentiment. They see the raw flow of metal moving into vaults, or more accurately now, flowing out of them. They see the order books before anyone tweets about them. They hear the phones ringing at the US Mint. They know when something is wrong long before the public is even aware there's a problem. So when institutions like JP Morgan or Citi are stepping in and buying silver around $92, that tells you almost everything you need to know. Banks do not buy at $92 because they were hoping to flip it at $95 and celebrate with a modest bonus. They buy at $92 because in their models, in their risk meetings, and in their private conversations, they see a price that looks a lot closer to $200 than to $80. That S, not optimism, that's self-preservation. What we're witnessing right now is not a normal rally, it's a cleanup operation. There are still hedge funds and smaller speculative players who are short this market. They're staring at technical indicators, pointing at overbought RSI levels, convincing themselves a correction is imminent, and under normal circumstances, that wouldn't be unreasonable. But these are not normal circumstances. The banks are no longer on the other side of the trade. They're now hunting those shorts. This is a textbook rug pull, but not on retail. On the remaining professional skeptics, the banks are pushing the price higher, not because they're reckless, but because they know exactly where the pain threshold is for those smaller funds. As the price rises, margin calls start firing off like alarm clocks nobody wants to answer. Positions are forced to liquidate, and the buying pressure feeds on itself. It's a cannibalization event inside the financial ecosystem. The big sharks are eating the smaller sharks, and the water gets very choppy in the process. This dynamic explains what we saw recently when the expected margin hike failed to knock the market down. Remember that dip that everyone thought would finally be the correction? It lasted about as long as a New Year's resolution. The price dipped, fear spiked, and then silver ripped higher almost immediately. That wasn't random. That was likely institutional buying, stepping in aggressively, using the fear as cover to build long positions. In plain terms, they bought what others panicked out of, and then let the market run. This is why the character of the rally has changed. A bull market driven purely by retail enthusiasm is fragile. It can be scared by a scary headline or a red candle. A bull market driven by banks is a different animal entirely. It's closer to a Super Bowl offense with an unlimited budget. They have the capital to defend levels. They have the incentive to push higher. And most importantly, they own the physical metal. Think back to the vault data we looked at recently. Over 1.3 million ounces leaving the JP Morgan vault. At the time, it was easy to assume an external whale was taking delivery, but consider the alternative. What if JP Morgan simply moved that silver from visible inventory to internal proprietary control? What if the metal didn't leave the building so much as it disappeared from the scoreboard? If the banks are hoarding physical silver for themselves, the motivation becomes obvious. They want higher prices. They want $100. They want $150. Every dollar higher turns into balance sheet fuel. This is where the irony becomes almost poetic. The institutions tasked with upholding the fiat system are quietly abandoning it, not out of ideology, but out of necessity. They are choosing survival over symbolism. So when you see silver trading near $91 or $92 and feel the instinct to say, this looks stretched, pause for a moment, what you're actually seeing is a market that's finally had the weight vest removed. For years, silver ran with resistance strapped to its back. That resistance is now switching sides. The Western leg is closing precisely because the banks are now incentivized to close it. They want that arbitrage gap, with Shanghai gone just as badly as anyone else, and they're willing to use institutional firepower to make it happen. That means the path to $100 in New York is not a lonely retail march. It's paved with institutional buy orders. But this is where a word of caution is warranted, especially for retail participants. Banks are not your friends. Just because they're long doesn't mean they're gentle. They are perfectly capable of engineering brutal volatility. They will create sudden air pockets where the price drops $10 in an hour, not because the trend is broken, but because leverage needs to be shaken out. If you try to trade against that, you will lose. The only way to survive it is to own the physical asset and ignore the noise. Ironically, if you hold physical silver, you are aligned with the banks for perhaps the first time in modern history. You both want the same thing, higher prices. This alignment is the signal that the long-awaited correction is not coming, at least not yet. Markets don't correct when the smartest, best capitalized players are just starting to build long exposure. They expand, they accelerate. We are entering what could be described as a blow-off phase, but not the Hollywood version that ends in a week. This could play out over months, possibly years. The banks have flipped, the mint is closed, Shanghai is pricing silver above $100. These are not weak forces. These are the heaviest hitters in the financial system lining up behind one asset. And yet, the most powerful force in markets hasn't even arrived yet. It isn't the Federal Reserve. It isn't a bullion bank trading desk. It isn't even China's industrial demand. The most powerful force in any market is the fear of missing out from the general public. And for the last 3 years, that force has been deliberately kept asleep. As silver climbed from $20 to $50 and then to $70, mainstream financial media maintained a near total blackout. They talked endlessly about Bitcoin, artificial intelligence, housing, meme stocks, anything but silver. It wasn't an accident. To talk about rising monetary metals is to quietly admit that fiat currency is losing credibility. It's an uncomfortable conversation, so it was avoided. But today, that silence broke. When silver prints an all-time high near $92 and Shanghai crosses $100, the story becomes impossible to ignore. The ticker forces the issue. We're now witnessing the media pivot. Over the next 24 hours, headlines will shift. Silver mania. Is silver the new gold? The industrial supercycle? None of this coverage is meant to help you. It's meant to explain away the failure of central banks. They'll blame speculators. They'll blame hoarders. They'll blame China. They'll blame anyone except the printing presses. But the narrative itself is irrelevant. What matters is the effect it has. When the average person, the dentist, the teacher, the small business owner, turns on the news and sees silver up 6% in a day and flirting with $100, something clicks. They look at their savings account yielding almost nothing. They look at grocery bills rising relentlessly. And then they look at silver. That's the moment the public wakes up. This is the capital handoff. Money flows from the early, patient buyers who accumulated at $30 to the late, panicked buyers rushing in at $90. The scale of this wave cannot be overstated. Trillions of dollars sit in cash, slowly evaporating. If even a fraction of 1% tries to move into silver, the price doesn't move smoothly. It gaps. But here's the tragedy. The public is arriving after the doors are already locked. The U.S. Mint has suspended sales. Private mints are quoting 8-week delays. Commercial vaults are being drained by whales. So when the public shows up tomorrow morning, credit cards in hand, what they'll find are empty shelves. This creates a liquidity vacuum. Markets need sellers to function, and right now there are none. Owners won't sell because they know what's coming. Dealers can't sell because they have no inventory. The result is exploding premiums. Spot might say $92, but if you want a physical coin today, you may be paying $140, if you can find one at all. That disconnect fuels panic. When people realize the screen price is fiction, they bid higher elsewhere. Auctions, private deals, forums, logic exits, emotion takes over. This is the mania phase. Your neighbor asks about mining stocks. Random channels pivot to precious metals overnight. Veterans watch quietly, not with glee, but with a kind of grim recognition. Because for the system, this is a nightmare. The banks rely on apathy. If the public abandons the dollar en masse for hard assets, velocity spikes, and inflation stops being theoretical, the Shanghai price above $100 gives the media cover. It validates the move. And once silver settles above the century mark, something strange happens. Instead of feeling expensive, it starts to feel necessary. People will say, "I remember when silver was under $100. And that sentence alone tells you everything about where the psychology and the price is headed next. There's a phrase people love to use when they miss something big. I remember when Bitcoin was under $1,000. It always sounds casual, almost nostalgic, but there's regret baked into every syllable. That sentence is about to get a silver-themed sequel. I remember when silver was under 100, because whether people are emotionally ready for it or not, the era of cheap silver is finished. And more importantly, the era of easily available silver is ending right alongside it. What we're moving into now is not an era of speculation, but an era of allocation. Silver is no longer something you casually add to a cart because it looks inexpensive. In the not-so-distant future, you may not even be able to simply buy it at will. You may need permission. You may need to be an industrial user. You may run headfirst into capital controls designed to stop ordinary people from converting weakening dollars into real metal. That may sound extreme, but the early signs are already here. The U.S. Mint suspending sales is not a footnote. It's a warning shot. As the mania builds, the restrictions will not loosen, they will tighten. Governments do not respond to shortages by encouraging access. They respond by rationing. Which brings us to the question everyone is quietly asking, but few are comfortable saying out loud: how high can this actually go? Under normal conditions, analysts pull out charts, resistance levels, and long-term averages. But when the public enters with force, the banks are no longer suppressing but actively buying, and industrial users are panic ordering just to keep the lights on. The old models stop working. The familiar resistance levels at $50 or $80 become historical trivia. We are no longer in a trading range. We are in price discovery. Could silver hit $150 next week? In this environment, yes. Could it hit $200 next month? Also yes. When you combine a short squeeze, a structural supply shortage, and a currency credibility crisis into one asset, the upside isn't T capped by charts, it S capped by the failure of the currency it S priced in. The real ceiling is the dollar itself. What we're witnessing is not about numbers flickering on a screen. It's about a massive transfer of purchasing power. Wealth is moving from those who ignored the warning signs to those who prepared quietly and early. And as the noise level rises, as the media frenzy accelerates, the disinformation will get louder. You will be told it's a bubble. You will be warned it's dangerous. You will be threatened with taxes, restrictions, and rules. But through all of that, one fact remains immovable. They cannot print more silver. That's the only fact that matters. The awakening has started. The sleepers are waking up, and they're all looking for the same exit at the same time. If you've stayed through this entire analysis, you understand the scale of what's unfolding. You understand that Shanghai breaking above $100 is not just a spike. It is a regime change. You understand that bank capitulation means the former suppressors are now the chasers. And you understand that the media pivot is about to unleash a wave of retail capital into a market that has almost no physical inventory left to sell. This is not speculation. The evidence is forensic. The vault movements, the mint suspensions, the price divergence, all of it points in the same direction. We are not watching a temporary anomaly. We are watching the late-stage failure of a fiat experiment that ran far longer than it should have. The age of cheap, abundant, paper-priced silver ended today. January 14th, 2026 will be looked back on as the line in the sand. So now we have to look forward. Once silver clears the century mark and stays there, the old rules don't apply anymore. Gravity changes. Markets behave differently. We move into a vacuum. And that raises the next obvious question. Where does this stop? Is $100 the top? Is $150 the top? To answer that, we have to stop thinking in dollar terms altogether. The dollar is no longer a reliable measuring stick. It's stretched, distorted, and shrinking in real terms by the day. Measuring silver in dollars right now is like measuring distance with a rubber band. The object doesn't change, the tool does. The better way to think about value is through relationships, not raw prices. Specifically, the relationship between the two monetary metals, gold and silver. Gold today is trading around $4,633 an ounce. It's up strongly and holding firm. Gold isn't just rising, it's anchoring. It's acting like the stabilizing reference point of a new monetary reality. Now look at the gold to silver ratio. For most of recorded monetary history, from ancient civilizations through the early United States, that ratio hovered around 15 to 1, roughly 15 ounces of silver for 1 ounce of gold. That wasn't arbitrary. It reflected geological scarcity and monetary utility. In the modern era, that ratio was deliberately distorted. It blew out to 80, 90, even 100 to 1. That wasn't natural. It was the result of decades of treating silver as a disposable industrial byproduct, rather than a monetary metal. Extreme ratios signal extreme suppression, but now the ratio is collapsing. With gold around $4,133 and silver near $91, the ratio is roughly 50 to 1, and falling. That alone tells you silver is not expensive, it's still historically cheap. Do the math. If silver merely reverted to its long-term monetary norm of 15 to 1 with gold today, S price, silver would trade around $308 per ounce. Let that sink in. At $91, silver isn't overheated. It's trading at a massive discount to its historical role. This is the catch-up trade, and everyone who matters knows it. Algorithms, central banks, and institutions alike. When gold becomes too expensive for the average saver, capital doesn't disappear, it rotates. It flows into silver because silver offers leverage to the same thesis with greater upside. This is why $100 isn't the destination, it's the sound barrier. And once that barrier breaks, and Shanghai has already broken it, the sonic boom won to be subtle. When silver settles above $100 in New York, likely very soon, investment committees that have never touched commodities will be forced to act. Pension funds will have to allocate. Endowments will have to rebalance. And they will be buying into a market with almost no supply available. Which brings us to the most difficult part of this conversation, the exit strategy. Many of you are looking at your accounts right now and feeling something close to disbelief. You bought at $25 or $30. You held through years of frustration. And now the gains are no longer theoretical. They're life-changing. The temptation to sell at $100 will be intense. Pay off debt. Upgrade your lifestyle. Take a well-earned victory lap. But this is where discipline matters most. If you sell silver for dollars, what are you really doing? You're exchanging a hard asset, that S gaining purchasing power, for a currency that's demonstrably losing it. You're trading the antidote for the illness. The dollar is not the finish line, it's the casualty. History is brutally consistent on this point. In every currency collapse, Weimar Germany, Zimbabwe, Venezuela, those who sold their gold and silver too early thought they had one, right up until they realized their paper profits couldn't buy groceries. They exited too soon and paid for it later. So when do you sell? You sell when you can exchange ounces for income-producing hard assets. This is the ounces to acres strategy. You don't trade silver for paper, you trade it for land, for rental properties, for businesses that generate cash flow, for energy infrastructure. You wait until silver is so overvalued relative to real assets that the trade becomes obvious. Right now, it might take thousands of ounces of silver to buy a decent house. In the peak of a true mania, that ratio can collapse to a few hundred ounces. That's the opportunity. That's how generational wealth moves. Not from cashing out, but from swapping one form of hard value for another. We are nowhere near that point yet. We're just leaving the launch pad. The gold to silver ratio is still around 50 to 1. We want to see 30 to 1, maybe even 20 to 1. The coming weeks will feel long. The volatility will be brutal. Even though the banks have capitulated on the short side, they will still manufacture violent swings to shake out leverage. Ignore the noise. Watch the flows. Is Shanghai selling? No. They're paying over $100. Is the U.S. Mint reopening? No. It's closed. Is industrial demand slowing? No. It's accelerating. The fundamentals are locked. There's no path back to $20 silver. That world no longer exists. We are entering an era of resource nationalism. Countries with silver will hoard it. Countries without it will scramble for it. And you, the individual investor, are standing in the middle of that storm holding something everyone wants. Don't let them shake you loose. Secure what you have. Educate your family. This isn't just about getting rich. It is about surviving a transition and coming out the other side with a seat at the table. The banks have lost control. The miners are depleted. The public is waking up. Shanghai is above $100. The trend is your friend. And right now, that trend isn't climbing, it's vertical.